Welcome to Talk Tickers. We get right into earnings calls, giving you the insights you need fast. Today, we're diving deep into Honda Motor Co.'s latest call, covering their fiscal year ending March 2025 and what they see coming for fiscal year 2026.
Right. So Honda finished their fiscal year, March 2025, with a reported operating profit of 1.2134 trillion yen.
Yep.
But, there's a bit of noise in that number. If you take out a one-time accounting change, something about warranties.
Okay.
If you exclude that, the operational profit was actually higher, 1.341 trillion yen.
Better. Okay.
Definitely better. And the big story really was the motorcycle business. Record highs globally. Sales, profit, margins, everything.
Wow. Bikes are booming.
Absolutely. The car side, though, a bit different. Unit sales were down, especially in China and the ASEAN region.
Why was that?
Well, partly it seems the EV incentives in North America actually impacted things, maybe pulling focus or resources.
Mm-hmm.
But on the plus side, their hybrid sales were up.
Hybrid's still strong then.
Yeah, definitely growing. And cash flow, operating cash flow after R&D stayed solid at 2 trillion yen.
That's a healthy number.
Yeah.
And looking ahead, FY26.
Okay, looking forward. They're being cautious. Projecting a minimum operating profit of 500 billion yen, net profit 250 billion. A big reason for that caution. Tariffs. I mentioned that quite a bit.
Oh, tariffs. Yeah, we'll definitely need to dig into that.
For sure. Motorcycles, though, they're aiming for growth again, 21.3 million units.
Still bullish on bikes?
Seems so.
Huh.
Cars, they expect hybrids to keep growing, especially in North America. But again, tariffs are a headwind. Oh, and one last thing from the overview. They changed their dividend policy. It's now based on dividend on equity, DOE.
DOE, okay. And the payout?
Increased.
Yeah.
Up 2 yen to 70 yen per share annually. So yeah, like you said, a year of contrasts and strategic shifts.
Okay, let's unpack that motorcycle performance first. Records across the board, you said. What's driving that? What's the secret sauce there?
Well, it really seems to come down to their strategy of sharing platforms and powertrains across different models.
Smart engineering.
Exactly. It keeps costs down, lets them be flexible, hit different price points globally. It's just very efficient.
And that translates directly to profit.
Directly. That operating profit, 663.4 billion yen for motorcycles last year. That's a huge jump from the year before. It really shows how leveraging that scale and smart platform strategy pays off, especially combined with managing pricing in emerging markets where inflation's been a factor.
Makes total sense. Scale and efficiency. Now, switching gears to cars, sounds like a tougher road. What were the main pain points?
Yeah, cars face more headwinds. The main things were those sales drops in China and ASEAN, key markets for them.
Right.
And then in North America, while hybrids did well, the cost of incentives needed to sell the pure EVs they do have, that definitely put pressure on profitability in that segment.
So a bit of a squeeze.
A definite squeeze.
But you mentioned hybrids are a bright spot. They seem to be doubling down there.
Absolutely. It's a clear strategic move. They actually pointed out their current hybrids are much more profitable.
How much more?
About 1.5 times more profitable than the previous generation. That's significant.
Yeah, definitely.
And they're seeing good demand globally, but especially in North America. So the plan is to launch next-gen hybrids later this decade, focusing on, even better performance and cost.
So it's leaning into a strength while maybe the EV market figures itself out.
That's exactly how it looks. I mean, look at their investment plans. They've actually postponed the big EV investment in Canada.
Oh, really? Why?
They said it's because the EV market growth in North America is just slower than they initially expected.
Interesting. So pragmatism kicking in.
Seems like it. They're shifting focus, at least for now, to boosting hybrid production in North America, using the factories and expertise they already have.
Yeah.
It feels very much like playing to their current strengths.
Okay, let's tackle the elephant in the room then. Tariffs. You said it's a big factor in their outlook.
Huge. It's casting a really long shadow. They put a number on it, estimating a 650 billion yen hit to operating profit for this fiscal year, just from tariffs.
650 billion. Wow. That covers USMCA and others.
Yeah, USMCA is a big part of it, but other policies too. It affects fast cars, components, the whole supply chain.
Yeah.
And part of the problem, they said, is just the uncertainty. The rules keep changing or the interpretation isn't clear, which makes forecasting incredibly difficult.
That's a massive number. Why is the USMCA impact so uncertain?
A lot of it boils down to the rules of origin for parts. Basically figuring out exactly what qualifies as North American content under the agreement.
Ah, the nitty-gritty detail.
Exactly. And because it's not totally clear how those rules will be enforced or certified for every single component, they have to be conservative. They're essentially planning for potentially tougher interpretations.
Which inflates that negative impact number. Makes sense. So how do they fight back against 650 billion yen in headwinds?
It's a multi-pronged approach. They're pushing hard on internal cost cuts, obviously, trying to find savings anywhere they can.
Standard playbook.
Right. Then there's optimizing product allocation, basically, trying to build and sell cars in ways that minimize the tariff burden. And they're even looking at increasing production inside the U.S., maybe adding a third shift at some plants, for example.
Build where you sell, basically.
To some extent, yeah. And they're watching competitors closely, seeing how they react, and keeping price increases on the table, though they'll be careful with that.
Sounds like they're pulling every lever they can. Okay, shifting slightly. Shareholder returns. You mentioned the dividend policy change.
Yes, the move to dividend on equity, DOE. The idea there is usually about improving capital efficiency. It ties the dividend more directly to the company's equity base, which can mean more stable, predictable returns for shareholders over time.
And the practical result was?
An increase in the annual dividend. It's up to 70 yen per share now. Plus, they're continuing with their share buyback program. They'd already bought back nearly 600 billion yen worth by the end of April.
So definitely focusing on returning cash to shareholders. Okay, back to that FY26 outlook. 500 billion yen operating profit. What are the big assumptions baked into that? You mentioned the exchange rate.
Yeah, the forecast assumes 135 yen to the dollar. But here's the really telling part. They said if you ignore the expected negative hits from Forex and tariffs.
The two big headwinds we discussed.
Right. If you take those out, the underlying operating profit would basically be flat compared to the year just ended.
So the core business is holding up. Okay, it's these external factors really driving the lower forecast.
That's the picture they painted. Forex is a big one too, not just the USDJPY, but they expect headwinds from depreciating currencies in emerging markets as well.
Okay.
Their plans to mitigate the tariffs, those cost savings we talked about, they only expect that to offset a fraction of the impact, maybe 200 million yen or so, against that massive 650 billion hit. On the positive side, they do expect higher sales volume for motorcycles and North American cars to help profit. But that's balanced against planned increases in general expenses and, importantly, R&D spending.
So investing for the future still, despite the pressures.
Seems so. It's a tough balancing act.
And that brings us to the longer-term picture, electrification. You said they noted the market's slower than expected. How is that changing their strategy?
Well, they're definitely acknowledging the reality check. The EV market growth hasn't been quite the rocket ship some predicted. So they're reassessing the timing of their full electrification push.
Meaning they're backing off EVs.
No, not abandoning it. The long-term goal, carbon neutrality by 2050, that's still firmly in place. But the roadmap to get there, the interim targets like for 2040, they're going to reevaluate the pace and the pathway.
More flexibility in the timeline.
Exactly. They're still developing and planning to launch new battery electric vehicles like that Zero series they announced. But the focus now seems to be on making sure those future BEVs are really competitive on cost and performance, maybe implying that current ones aren't quite there yet globally.
Okay. And their view on the U.S. market specifically?
They seem to think EV adoption in the U.S. will be pretty gradual over the next 5 years or so.
Yeah.
Maybe picking up more significantly after 2030.
So hybrids for now, EVs for the medium to longer term.
That looks like the revised game plan, adjusting to market realities.
Got it. And one final piece of news from the call, an executive change.
Yes, that's right. Executive Vice President Mr. Oyama resigned. The company's statement cited inappropriate conduct.
Ah.
Yeah. Honda apologized to stakeholders. Mr. Kihara is stepping up to cover those EVP duties. And another executive, Mr. Name mentioned in outline, but not provided placeholder used, will now head the automobile division. So a notable shuffle in leadership.
Okay, understood. Right, let's move to our favorite segment. This is not financial advice. Based on this Honda call, what's an outrageous but plausible trade idea we can toss out there? Remember, folks, purely for discussion and entertainment.
Okay, outrageous but plausible. How about this? Playing the hybrid strength against pure EV pressure. Trade idea 1. Go long Honda ADRs, their U.S. listed shares, and simultaneously short shares of a, let's say, high-profile, pure-play North American EV maker.
Okay, interesting. What's the thinking?
The rationale is Honda's looking pretty solid with its profitable hybrids, especially as the EV market maybe cools off a bit or grows slower than expected in North America. They've got that buffer from the motorcycle division too, which is, as we heard, doing incredibly well.
Right, diversification helps.
Exactly. Meanwhile, the pure-play EV companies, they could face more pressure on margins, growth expectations, valuation, especially if consumers hesitate on EVs, or if established players like Honda really make inroads with compelling hybrids and eventually competitive EVs.
So you're betting on Honda weathering the transition better in the near term compared to a pure EV bet?
Essentially, yes. It's a bet on relative performance in a shifting market. Again, totally speculative, not advice.
That's really. Okay, how about one more?
All right, trade idea 2, a bit more complex. Thinking about that postpone Canada investment, how about buying Honda bonds, say maturing around 2028, and selling short Canadian dollar futures?
Okay, walk me through that one.
Well, Honda pushing back that big Canadian EV investment by at least 2 years means less major capital expenditure there in the near term. That could look good for their near-term financial stability, maybe supporting their bond prices.
Less spending, potentially stronger balance sheet near term.
Right. And at the same time, while maybe a small factor, a major automaker delaying a big investment could slightly dampen sentiment around the Canadian dollar, or at least not help it.
So you're betting on Honda's bond stability due to lower near-term spending in Canada and maybe a tiny bit of CAD weakness related to that news.
That's the outrageous but plausible angle. It ties directly into that strategic shift away from immediate large-scale EV investment in Canada. Again, highly speculative.
Understood. Outrageous, but plausible indeed.
Yeah.
Okay, well, that wraps up our deep dive into Honda's latest earnings call. Key takeaways seem to be: motorcycles absolutely killing it, cars facing challenges from tariffs in a shifting EV landscape, a clear strategic pivot to leverage their hybrid strength, especially in North America.
And that commitment to shareholder returns through the new dividend policy and buybacks, despite the profit headwinds.
Definitely. The big things to watch going forward are clearly how those tariffs play out and how their long-term EV strategy continues to adapt, right?
Absolutely. Those two factors will be critical for Honda's performance.
So lots for you listeners to think